Welcome everybody to Shut Up and Ask, where no mortgage or real estate question goes unanswered. I'm Fernando Zilli, and let's get into today's questions. Today's first question is, why won't the bank qualify me for more? Or sometimes it is, my friend has the same job as me, and he qualified for a much larger mortgage than I can qualify for, and I just don't get it. Most people think that mortgages are qualified exclusively on income. Unfortunately, that isn't always the way. Let's start with the obvious factors. The more income you make, the more you can generally qualify for. The reality is, though, is that not all incomes are viewed the same. Salaried income is pretty straightforward, but other sources of income like self-employed income, rental income, investment income, spousal support, child support, commissions, tip income, bonus income, all of that is viewed in a completely different format. I'll do my best to explain how lenders will view this in greater detail. However, this is one of those situations where a one-on-one chat is generally the best way to determine what income can be utilized. Essentially, different lenders will view these incomes in completely different ways. One lender may approve you for one amount, and another lender may approve you for a higher or lower amount. Doesn't really make much sense, but there is a reason why there are multiple lenders out there. It isn't just to offer different interest rates. They all have their own products, services, and have their own lending policies. That's why it's really important to have a one-on-one overview of your current financial position, including all your income sources, to determine which lender is best suited for your needs. That raises the next question. If income isn't all that matters, what else matters? Debt matters. And this is where most buyers get caught off guard. They focus for weeks, months, years, in some cases even decades, to save up as much money as they possibly can to eventually purchase a home. The reality is that many times people prioritize savings over debt repayment. This isn't always the best course of action. Let's look at an example. Two completely different buyers, each making $100,000 per year. One buyer has no debt, the other buyer has car payments, a line of credit, and credit card balances. Even though they earn the same amount of income, their mortgage qualification could be drastically different due to this. Because lenders don't just look at what you make, they also look at what you owe. Now that leads to another question. How much does my car payment really affect me? Often more than most people realize. A large car payment can impact your mortgage qualified power significantly. In many cases, it can impact your borrowing power by 5 or even 10 times the amount remaining on your car loan. Which leads to the next question. Should I just use a bunch of my down payment and funds available to pay off all my debts? Sometimes yes, and sometimes no. Many buyers are surprised to realize that they can actually qualify for more by paying off debts and reducing their down payment. There is a trick to this though. Sometimes paying off the right debts will actually help you more than paying off all of your debts. Again, this is a situation where it may be best to have a one-on-one call with me so that we can explain that in greater detail and build a proper financial plan for you. Another topic that comes up often is clients saying that their bank qualified them for, let's say, $600,000. They're unsure whether or not they should fully spend the $600,000. The reality is that $600,000 figure that your bank gave you is an arbitrary number that is used as a guideline. Now, when they provide that information to you, there's usually an estimated property tax. If it's a condo or townhome or a stratified property, there would be strata fees included, and therefore they would use a hypothetical figure in there as well. When you find a property that you're interested in purchasing, those numbers can be vastly different. If your pre-approval was done with property taxes of $2,000, but the new property that you're really interested in has a property tax amount of $2,500, that can change your application and the amount that you can actually qualify for. Same goes for strata fees. If the strata fees that you were pre-approved on are $400 per month, but the place you're really interested in purchasing has strata fees of $600 per month, again, that can impact the maximum amount you can qualify for. Therefore, it's always recommended to have not only a financing condition, but also sufficient time for you to get building inspections and a number of different factors so that you can determine that this property is suitable for you. Now, what if that $600,000 that your bank offered you isn't enough? Are there ways to improve your mortgage qualification power? Now, this is where strategy comes in. Paying off debts, adding rental income to an application, looking at other sources of income, adding a co-signer or co-borrower to the application are just a few ways that we can look to increase the overall qualifying potential of your application. There's also different mortgage products which may yield you a higher pre-approval amount. For example, sometimes, in many cases, variable rates are actually lower than fixed rates. If you're somebody who is able to take on a little bit more risk and is comfortable with that and it's not going to keep you up at night, the reality is a variable rate in many cases will help you qualify for more than a 5-year fixed rate loan. So maybe a variable rate is the right product for you in that case. However, just keep in mind that variable rates can fluctuate and it's not the right product for everybody. Another way to improve your overall borrowing power is just simply to look at different lenders. As mentioned, every lender looks at different income in different ways. properties. Some lenders will only use a certain percentage of rental income and other lenders will use more. Some lenders will only let you use a certain level of child support income. And some lenders will only let you use a certain level of your business, self-employed business income. There's a lot of different options out there, hundreds of lenders out there. And to be honest, it's a lot for an individual borrower to try and research and learn on their own. This is where you need to sit with somebody who you trust, that's going to give you the straight goods and the information that can help you make the right decision for your specific needs. Now let's talk about credit. One, will pulling my credit hurt my score? A mortgage credit inquiry has a very small impact on your credit score. However, having multiple pulls by multiple financial institutions when shopping your mortgage can have a negative impact on your credit score. That's where working with us has a significant advantage. For example, when we pull your credit score, we pull it once and we're able to submit that application, including your credit score, to multiple lenders. And in many cases, those lenders will just use the credit score that we have provided and not pull their own credit score. If they choose to pull a credit score, in many cases, those credit scores are seen as credit scrapes. So they don't actually impact your credit score. They kind of just update and re-verify the information that we've provided the lender. So in essence, we can submit your application to 10 different lenders and you won't have 10 different pulls. You might only have one. What is often more important than just simply having your credit pulled is your credit utilization. Credit utilization means if you have $500 in available credit and you're using $100 of that available credit, you're effectively using 20% of your available credit, which means you would have a 20% utilization. That is a pretty safe amount. However, if you had a $500 credit limit and you had racked up that credit card to a maximum of $500, you would be at 100% utilization. Therefore, your credit would be more impacted by that than having your credit pulled. Some people believe that having the least amount of credit available to you is the best solution. The reality is, if you have a $1,000 limit on your credit card and you continually spend $1,000 a month but pay your credit card off, the reality is that during that period of time while your credit card is reporting to the credit agency, you may be at a very high utilization, as high as 100% of your credit profile. However, if somebody had a $10,000 limit on their credit card and they spent $2,500 per month, they would only be utilizing 25% of their total available credit. So even though they borrowed more, they actually will have a higher credit score in many cases because their utilization of credit is not as high as yours. So in essence, it's the utilization of credit, which is probably the biggest factor in your credit profile. Of course, other factors like making payments on time, any collections. The big one is obviously cell phone bills, because nobody wants to pay their cell phone bill when there's a dispute on the amount that's owed. The reality is that when you have a mortgage application, lender is going to want to see that that's paid off, whether you feel like you owe that money or not. So it is really important to review your credit prior to making any offers. Now, you can choose to sign up for Equifax or TransUnion as a consumer account and manage and monitor your own account to determine what your credit profile is. The reality is that is a little bit of a different score than we're going to see on our end, but at least it's a good point of reference and you'll know if there's any major significant changes that apply to your credit. Now, before I wrap up, the last question we'll go over is, should I get pre-approved before I start shopping for properties? If I'm going to have a financing condition, why don't I just go through the process at that time? The pre-approval is important for a number of different reasons. One, it helps you understand what your mortgage qualifying power is prior to making any offers. Two, it holds an interest rate for you for a period of up to 4 months, which allows you some monthly payment certainty in the event that market fluctuations change interest rates while you're going through the home buying process. It also gives you a clear indication of what your down payment requirements are. It also lets us know if there's any specific issues that need to be addressed with your credit profile prior to making any offers. This can alleviate a lot of stress, so you're not struggling to call Equifax to deal with a credit inconsistency, calling past creditors to resolve missed payments or collections. Sometimes there's just duplicate profiles. If you had a name change or you got married and changed your name, sometimes you'll have 2 credit profiles that will need to be merged, and this can take up to 30 days in some cases. So it is really important to get these things out of the way before you start making offers on properties. So what are the takeaways from today? Your approval is based on much more than just your income alone. Debt matters, credit matters, property type matters, and different lenders can produce very, very different results in terms of interest rate, qualifying amount, and a number of other factors. And the reality is, if you're unsure, the simple thing to do is shut up and ask. This is exactly why this series exists. Thanks for watching, and we'll see you next time.